Silver is likely heading toward the $63 per ounce zone, and if that happens, that move should not be feared, it should be prepared for. Because this pullback is not the end of silver's strength, it is the early phase of what looks like a much larger supercycle. Over the last 24 hours, silver prices have been extremely volatile. Sharp moves, sudden drops, and emotional reactions have left many traders questioning whether the bull market in silver has already peaked. Today, that question deserves a clear and rational answer. To understand what just happened, perspective is everything. Silver experienced a violent sell-off, dropping from 82 down to 72 in a single session. That move looks dramatic, but in reality, it only erased the gains made on Friday. Price simply returned to where it was trading earlier in the week. Just days ago, silver surged toward $80 after reports that China could restrict silver imports, raising fears of supply disruption. That spike attracted heavy speculative interest. Even after today's decline, silver remains up 136% year to date. Moves like this are not unusual in commodity markets, especially in gold and silver during strong trends. The real driver behind today's drop was not fundamentals, it was leverage. Large institutional traders do not primarily trade physical silver. They trade silver futures, which are contracts tied to future delivery dates rather than actual metal. These contracts almost never result in physical delivery. Positions are closed long before that point. The appeal of futures is leverage. A single silver futures contract controls 5,000 ounces of silver. For every $1 move in silver, the value of that contract changes by $5,000. At Friday's closing price of $77 per ounce, 5,000 ounces of silver represented $385,000 in notional value. Yet traders only needed to post roughly $22,000 in margin to control that position. That is leverage of approximately 17 to 1. Silver rose nearly 60% this quarter. But because of leverage, futures traders were seeing gains far beyond that. In many cases, margin positions of $22,000 ballooned into profits exceeding $200,000. When traders see those kinds of returns, behavior changes. Profits get recycled into additional contracts, positions expand, and price acceleration becomes extreme. This is how parabolic moves form. We have seen this pattern before. Last year it was cocoa futures, which exploded from around 4,000 per metric ton to nearly 12,000 in a matter of months. Many of the same participants involved in silver today were active in that move as well. But there is a built-in circuit breaker in futures markets: margin requirements. When price volatility increases dramatically, exchanges such as the Chicago Mercantile Exchange raise margin requirements to protect the system. This is not manipulation, it is risk management. Silver dropped nearly $10 per ounce in a single session. With 5,000 ounces per contract, that represents a $50,000 loss on a position backed by roughly $22,000 in margin. That scenario triggers margin calls. The CME raised silver's margin requirements from approximately $22,000 to $25,000. While that change may seem modest, the maintenance margin is what matters. If account equity falls below that level, positions are forcibly liquidated. Forced liquidation is what ends parabolic moves. It happened during the Hunt Brothers episode in the 1980s, when regulators raised margin requirements and massive positions were unwound. The selling becomes mechanical, not emotional. That is exactly what occurred here. The sell-off did not signal a collapse in demand. The world did not suddenly discover hundreds of tons of new silver supply. What occurred was a textbook blow-off top, driven by excessive leverage and followed by forced selling. Looking at intraday charts, silver spiked from 80 to 82 shortly after the Sunday evening open, then rapidly reversed. Within 30 minutes, prices dropped nearly 7%. Minor rebounds were followed by further liquidation throughout the session as brokers issued margin calls and closed over-leveraged positions. When markets move this fast, emotion overtakes logic. Leverage replaces patience. Corrections become violent. Sentiment at extremes always behaves the same way. At tops, expectations become unrealistic. During pullbacks, confidence collapses. So the question becomes, what happens next? Focusing on the daily chart, the key issue is how far price retraces from the parabolic portion of the move. Silver surged from roughly 50 to 80 in about a month. That portion of the move became overstretched. A 50% Fibonacci retracement of that parabolic leg points toward the $67 area. Extending that to the 61% retracement places support closer to $63 per ounce. That $63–67 range represents a high probability zone where buying interest is likely to return. The path is unlikely to be smooth. There may be false rallies, sharp breakdowns below $70, and widespread pessimism before stabilization occurs. From a long-term perspective, nothing has changed. On a multi-decade logarithmic chart, silver appears to be breaking out of a structure that has been forming for more than 60 years. What followed the Hunt Brothers era was a massive multi-decade cup and handle pattern that is only now resolving higher. Viewed through that lens, short-term volatility becomes noise. For those willing to hold silver for 3, 5, or even 10 years, price targets far beyond current levels remain plausible, including ranges well above $200 per ounce over time. This move was not the end of silver's story. It was a reset, and resets are where long-term opportunities are often created.
Hello my dear friends, welcome back to my another video and my channel. So friend, this is my channel Money Made Simple. So please support me. So friend, today silver is likely heading toward the 63 per ounce zone, and if that happens, that move should not be feared. It should be prepared for, because this pullback is not the end of silver strength. It is the early phase of what looks like a much bigger supercycle. Over the last 24 hours, silver prices have been extremely volatile. Sharp moves, sudden drops, and emotional reactions have left many traders question whether the full market in silver has already peaked. Today, that question deserves a clear and rational answer. To understand what just happened, preparative is the everything and everything silver expand a violated sulfur dropped from 82 down to 72 in single session. That move looked dramatic, but in reality it only raised the gains made on Friday.